Traders say news from the Central Bank of Nigeria on ways to curtail abuse of the dollar by dealers brought some respite to the forex market. Also beginning from Thursday and the whole of September, traders say more maturities coming will increase the liquidity into the system and further depress yields. Gbemisola Bello-Aromire, a fixed income dealer at UBA, joins me from Lagos to discuss more on this. Thank you so much for your time on the show, Gbemisola. Let's first start with what's happening in the market today. Was I understand that is a Treasury bills auction. What has the participation been like?
Okay, thank you for having me, Ken. So there's the PMA today, where we have almost 197 billion on maturity, which the central bank on behalf of the DMO would roll over. We have 20 billion on the 91 days, 31 billion on the 182 days, and 145 billion on the 364 days. For that space, a lot of retail demand would be what will be visible at today's auction. Market already perceives that rate might drop slightly at the auction, because this has been the norm for the previous auction. Participation will be high, as I said, but more of retail customers. For the NTB space in the secondary market has been relatively quiet from the beginning of the week up to today. Reason being that the unattractive yields at this market, coupled with low supply of NTB, has been the reason why a lot of people have been evading that market for NTB. But for the almost space of the fixed income, we've seen a lot of demand. This demand arose mainly because of the high liquidity in the system. There was spark payment from last week and some bond coupon payments. So traders increased their demand for OMO maturities. And today we saw yield rates at that space at 2% levels, 2.8, 2.9 levels. Rate continues to trend downwards as a lot of demand continues to peak on the supply, which is limited at the secondary market for now. We hope that we'll get more pumping from the CBN so that the amount of maturity will be sufficient for the supply that we would get from the central bank. On the bond space, where as the GDP figure came in on Monday, we saw a very weak market. A market that had already been quiet for the most part of the week became completely mute as the GDP figures made the market more feeble. Market became bearish. A lot of people increased their offers because they wanted to sell. But even at 10% levels, we did not see any demand coming to that market. Fundamentally, GDP, which usually brings investors to the market, brought a dampened mood. And in the bond space, what we just see is local investors coming in because of liquidity.
All right, then let's look at what the CBN has been up to in trying to, work around the abuse of the dollar by traders. What would you make of this move, and what sort of impact are we seeing in the market? I understand you're saying the market is getting some respite based on this.
Well, with the news of the central bank trying to curtail third party for LCs, I think just this news alone brought some stability to the FX market. The liquidity there is still weak in the FX window. We saw, though, that the INU remained at 385.99 yesterday. There's still a lot of unmet demand. But we hope that this new policy, this new trend would help curtail a lot of speculative buying, a lot of rates that are not what the market wants it to be. But inflow into the FX market is still very low. The demand backlog is still quite high. What we need there is an uptick in FPI inflow that can bring it to a more stable level. A lot of unmet demand there we're seeing is trickling into the parallel market. That's why we see that market go as high as between 477 and 480 in the parallel market. So we think it's a welcome development, and we hope that this can be maintained for a long period of time, as I'm sure it would have it relieve the bit of pressure on the FX window.
All right, I'd like to get your thoughts, though, on the yield environment and what we can expect going into the near term.
For the near term, there's a lot of liquidity. Starting from tomorrow, we have huge OMO maturity coming into the system. And because of this, and we also have for the whole of September, we have almost 1.6 trillion maturing for both NTB and OMO. We have almost 200 billion coming in as bond coupon payments. What this implies is that traders would have to invest this funds back into the security market. And this will further depress the yield because the amount of maturity will not be able to meet up with the supply we're getting both from CBN and from the DMO. Investors will most likely seek alternatives with more favorable returns. We're seeing that most probably a lot will face commercial papers coming into the week. The bond market will also be bullish, and so we expect that yield is going to trend further down. As I said, the anticipated liquidity coming in for the end of August and the whole of September would chase the few security in the market. We're hoping that if the CBN can inject more security into the system, maybe this would revert back the yields that we think is going to be on a downward trend. Although for them, the amount of debt and the cost of debt has reduced significantly for them, so I don't think they might increase this offer. But for our market to pick up, for yield to reverse, increased volume is the only solution to this quiet trading activities we've been seeing, low level of trades also in the market. So the coming weeks, we're going to see depressed yields coming for the end of August and the whole of September.